It's only January on Wall Street, but already the largest U.S. banks are doing some serious spring cleaning. They're trying to rid their books of toxic debt and start 2008 fresh. And many on Wall Street say they like what they see.
This is the point at which it makes the most sense for the banks to get it all on the table, clear the decks and move forward, because any sort of risk and uncertainty around the valuations of these balance sheets is going to weigh down on the valuations of the shares in the short term.
Citigroup this week wrote down more than $18 billion of subprime exposure, recording a nearly $10 billion quarterly loss, the worst ever in its storied history. The largest U.S. bank is looking once again to distant shores for help. It lined up $14.5 billion in new aid, mostly from Saudi Arabia, Kuwait, and Singapore. It's a similar story at Merrill Lynch, which got more than $6.5 billion in new capital, most of that money coming from Kuwait, South Korea, and Japan. Merrill also announced a stunning multi-billion-dollar subprime write-down. Banks may be on their way to cleaning up their subprime mess. Now the fear is what lies in wait after subprime. A slowing economy could force consumers and corporations to default on more debt, triggering billions in new bank losses.
The vulnerability would really be on the consumer side as opposed to the corporate side, and I would expect weakness in credit cards and other consumer-based structures to be the most apparent and the first to be realized.
Indeed, Citigroup rattled investors Tuesday when it said it was setting aside billions to cover possible consumer credit defaults, a sign that it fears big consumer pain ahead. Still, there may be a bright spot for banks. Some argue bank stocks may be close to bottoming out.
While I think that the bad news still has more room to run, I also think that these stocks are coming very close to discounting all of this bad news. We're in a bear market for financials. These stocks are down 30% on average.
So it's still crunch time for U.S. banks as the highly leveraged economy weakens and Americans scramble to make ends meet. The hard lessons learned about borrowing and lending in 2007 will no doubt linger well into 2008. Ines Ferre, CNN, New York.